If you have $1,000 sitting in your bank account, you might be feeling the immense pressure to do something brilliant with it. People often freeze because they assume they have to find the next Amazon or the next Nvidia and put all their hopes into that one perfect choice. Relying on one company to carry your entire future is a gamble. If you put your entire $1,000 into one business and that business fails, your money disappears. Instead of betting everything on a single tile, you can focus on putting the right pieces in the right places over time. Today, we are going to walk through 5 practical strategies to turn your starting cash into a solid investing plan, and you do not need a finance degree to pull this off. By combining a few simple building blocks, we remove the stress of picking winners. We let repetition and patience do the heavy lifting for us. Let's start with the first piece of the strategy. If you want a sturdy base, you can use something called a broad market index fund. This shows how it works. Instead of trying to guess which single company will succeed, an index fund allows you to buy tiny pieces of thousands of companies at once. Because your money is spread widely, you have a safety net. If one company collapses, the rest of your structure holds firm. Next, we move to building a habit. Instead of trying to guess when to buy, you can simply pick a day and a dollar amount and stick to it every single month. This approach, known as dollar cost averaging, removes the stress of the calendar. When the stock market goes up, people feel like geniuses and want to buy everything. When the market drops, panic sets in and they want to sell. Making decisions based on your daily emotions is exhausting, and it usually leads to buying high and selling low. To bypass that temptation, you can choose a set amount, say $100, and have it invested automatically through your bank. It happens in the background while you go about your week, regardless of whether the market is up or down. Combining a diversified fund with an automatic schedule transforms investing. You stop worrying about daily news headlines and turn your plan into a quiet, mechanical wealth machine. As you grow your money, you will encounter distractions. Someone online will always try to sell you on a hyped-up stock trend or an investment promising massive cash payouts. Strategy 3 is to ignore the noise and evaluate what an investment actually delivers. This means focusing on total return. An investment might pay you regular cash dividends, but if the investment itself is rapidly losing value, you aren't actually getting ahead. Total return looks at the whole picture, the amount your investment grows, plus any income it produces along the way. The fourth strategy involves choosing how to split your money between different buckets, like stocks for growth, bonds for stability, and cash for emergencies. This specific mix, your asset allocation, is what determines how your money behaves. A 25-year-old investing for retirement needs a very different mix of assets than someone who needs a house down payment in 3 years. Resist the urge to copy a stranger's portfolio from a social media post. Your mix must match your own timeline and how much market panic you can realistically handle. Over time, some of your investments will naturally grow faster than others, throwing off your intended mix. Rebalancing is a periodic checkup where you adjust your investments, shifting money around so your portfolio brings everything back into alignment with your original plan. This brings us to the fifth strategy, building a system designed to ignore the daily financial news. Money comes in. A portion gets invested automatically into your chosen mix, and you keep going, regardless of the market noise. Mastering these pieces, total return, your personal allocation, and a rigid system, creates a defensive wall against the biggest threat to your money, your own urge to make emotional decisions. The real engine driving this whole process isn't a complex algorithm or a lucky break. It is the combination of time and consistency. As your early investments generate returns, those returns generate their own returns, causing your growth to accelerate as the years pass. The investor who succeeds is rarely the one reading stock charts every Tuesday. It is the one who sets up a repeatable process and lets it run quietly in the background for years. Those 5 pieces are: build with index funds, automate your deposits, focus on total return, choose your personal allocation, and maintain a consistent system. But before you put your first $1,000 into the market, we need to pause. You have to make sure your financial foundation is actually secure enough to support these investments. If you carry expensive credit card debt, or if you do not have cash set aside for an unexpected medical bill, putting your money into stocks can backfire. You might be forced to sell your investments at exactly the wrong time just to cover a sudden expense. Practical financial health comes from making the right choice for your current situation. To figure out exactly where your $1,000 should go first, whether it belongs in debt payoff, savings, or investments, click the video on your screen right now. We will walk through the exact order of operations for your money.